All right, testing 1 2 3. Testing 1 2 3. Quick audio check, please. Let's type a 11 in the chat if you can hear me and see my screen. Type 11 in the chat. 11 for the month of November. Thank you, Doug, Marianne, Phil, Dick, Elon. Not Elon Musk, are you? Right, how's everybody doing today? Give me a couple moments here. We'll get started in about 45 seconds, 45, 60 seconds. Make some adjustments to my screen here, and we're going to get started. I'm excited to be here, and thanks for joining me. And we'll go ahead and get started here in just a few moments. All right, gang, I'm back. If you can, do me a favor, just want to do another quick audio visual. I want to make sure everybody can hear me and most importantly, see my screen. Don't want to spend an hour here with you not being able to hear or see me. So if anybody can do me a favor, let me know. Thank you, Beatrice, Cliff, Bill, David. All right, clear and loud and clear. All right, gang, let's go ahead and get started. I don't want to waste anybody's time. If the audio is sketchy at any time throughout the presentation, just give me a shout out, let me know. Or if you're having any other difficulties, one thing I would suggest, you can try F5, hit refresh, and or log out, log back in, but I would try to stay logged in if you can. We got a pretty packed house today. This is a brand new presentation that I'm doing. It's called "'Tis the Season for Proven Profit Patterns." If you stick around to the end, actually I'm going to prove these patterns to you throughout the course of the presentation of the next 60 minutes or so. I encourage you to stick around because I'm going to show you my hot list going here into the end of the year. So can anybody put a 2 in the chat if you've seen any of my presentations before? Put a 2 in the chat if you've seen any of my presentations, or maybe a 1 in the chat if you are brand new, have not seen me or heard me speak at all. So let's see where everybody is. Yes, we are recording, but I can never guarantee technology. So we're going to try to keep this to about 60 minutes or so. And I promise it will not be a waste of your time. As always, ask all the questions that you want during the presentation. I will try to address them, but I like to wait and get to the end of the presentation, then I'll start addressing those individually. All right, so a lot of people have seen or heard me before. Some of you haven't, that's great. And I hope you learned something. So let's talk about "'Tis the Season for Proven Profit Patterns." Let's go ahead and get started here. Before we begin, we must always start by reading the risk disclaimer as required by the regulatory governing body and our attorneys who require us to share. Past performance is not necessarily indicative of future results or a substantial risk of loss associated with trading. Only risk capital should be used to trade. You can lose money in trading. Cliff Notes version of that means don't trade with your milk money, your mortgage money, your rent money, your child's educational funds. You can lose money in trading. So let's get started here. I'm very excited to share with you because these are important times in the market. The key themes that I really want to cover are these 4 bullets right here. Let's talk about what these mean. So what this means is we are entering the best 6 months for stocks. Begins in November, and as you've seen, we provided a pretty good jump out of the gate. The S&P 500 has averaged a return of 1.4% in the second to last month of the year over the last 50 years. It's 5 decades. The result matches the strongest average monthly return of the year, an honor only shared with the month of December, which follows November. So the frequency of gains for this month is 70%. Returns have ranged from a loss of 11.4% in November of 1973 to a gain of slightly over 10%, or 10.2 to be exact, in November of 1980. We see strength typically continuing through the last month of the year, peaking around the start of January when trading returns to normal following the holidays. That's when the large funds, institutional players start coming on board. So we're going to talk about some key things that need to happen to continue that high probability seasonal strength. We're going to talk about a specific time frame or time frames for short-term tops and bottoms. We're going to look at Santa's favorite stock sector and some of his least favorite sectors. And then we're going to take a look at a handful of markets which have made the list, at least up to this point, and what we expect going forward. So if that sounds good, let's go ahead and continue. Other themes, as I said, we're entering the strongest time of the year. Markets benefit from various investor buying patterns and fundamental influences that lift stocks from fall to spring. Over the last half a century, it's 50 years of data, the S&P has gained an average of almost 8.5%, 8.45% between end of October and the start of May. The benchmark was higher 80% of this favorable time period. So that's pretty exciting data. So I'm very pleased to share this with you. We're going to get into all of this in more detail. But first, let's shut everything down, shut the distractions, turn off CNN, Fox News, Bloomberg, CNBC, whatever you're watching. Hush the baby, turn off Facebook, close the browsers, shutting down Netflix. No binging on your favorite show during the presentation. So we're going to be together for about 60 minutes again. I am recording it, cannot guarantee it. So let's take notes. I'm going to quickly introduce myself again. My name is Silas Peters. I'm the founder, head trader, seasonal swing trader. It's me standing in front of my alma mater at the University of Alabama in Tuscaloosa with my 2 beautiful daughters. 3 days after I graduated, I sold my car, packed up my belongings. I headed north, the great city of Chicago, the old Windy City. So while there, it's where I basically cut my teeth in trading, or the commodity markets, specifically working at the Chicago Board of Trade. I was immediately bitten by the trading bug and never looked back. What did I do there? Well, I helped run a global trading desk, placing and managing books of trades across the Americas, Asia, European sessions, primarily working with large block order flow for hedge funds, banks, CTAs, other large floor spec traders. Also been a part of building and managing several futures and equity brokerage firms, managing operations, trading, back office, and more. Also worked as a private family office investment consultant for ultra high net worth individuals. Have held these various futures and securities licenses. And then in 2016, I launched Seasonal Swing Trader. Like to talk about my journey. It wasn't always easy. In fact, there was a learning curve, several obstacles and hurdles on the path to where I am today. First step was obviously learning. School does not teach real life experience in the markets. Most of us probably know that. In the beginning, I made some money. In fact, I made a substantial amount of money. Was I lucky? I like to not think so, but ignorance and greed cost me my profits. I blew up an account, then I blew up several others, was quickly humbled by the market. I finally went back to my roots, settled down, worked my process, and found overall consistency. So I hope that's what I can instill to you today. But let me ask, why are you here? You're here to learn proven profit patterns, patterns that are consistent, patterns that repeat themselves over and over again, patterns that are driven by underlying fundamentals, that are pushed and pulled by significant influences, that are based on what is actually occurring in the world economy, the environment, and more. This is no fluffy, holy grail secret pattern. These are things that are actually driving forces between what I'm going to show you. Why is it so important? Because when you're armed with these specific weapons, you can become consistent. You can position yourself for higher odds trading or investing, and you can ignore the outside noise. And if anything, out of these bullets, they're all very important, but being able to ignore the outside noise is very self-liberating. And if you can tackle these three things, you can position yourself for best success. So what did I find over my years? There's no holy grail. Stop chasing shiny objects. Stop clogging your charts with useless indicators. And very simply, you got to put in the work. Only if you wish to succeed, and I would suspect most of you do, or you would be here. And that's what we're going to talk about. We're going to talk about these proven profit patterns. We're at a very ripe time of the year for these to occur. In fact, they occur every week, every month throughout the year, but we're going to talk about a very specific time frame that we're getting into. So let's talk quickly about the current market outlook. As we all know, the economy became dislocated from seasonal norms, with activity coming in much weaker than average as all these shutdowns burdened economic activity. But as we subsequently saw, restrictions were lifted, and then consumers were creating their little pandemic bubble. Activity surged. We saw some buying, lifting sectors like retail and others to the strongest year-to-date change on record. It's been a huge benefit to stocks, even amidst all of the crazy year we've had, or the youngsters like to say hashtag 2020. It's so 2020, and it's certainly true. The pandemic has certainly skewed what is or has been normal. However, skew compared to seasonal norms was also apparent in the spring and summer, when the S&P gained 18.2%. It's the second strongest gain over this time frame in the past 50 years, following just short of the 20.2% recorded in the spring and summer of 1980. So continuing on with this theme, the ramp in the number of corona cases in the US and around the globe is once again, not surprisingly, catching the market's eye. How the record high coronavirus case count is, the rising level of deaths, the rising hospitalizations will impact the economy and the equity market. We have to leave to speculation for now, but it seems unreasonable that we'll see a complete derailing of the path of the market and the economy from the seasonal norms as we saw in March and April. So the performance of the economy and the equity market through the final couple of months of the year is highly dependent on the strength of the consumer. So while data points to a favorable fundamental backdrop, we cannot help but contemplate how the next stimulus bill may also influence seasonal activity. We have to talk about it, all politics aside. Let's talk about the impact of the election, or maybe some may say the lack of the election. The average performance of the S&P during years when the incumbent party loses the office of president has been an effective guide for the path of the broad market for years and years. And I'm going to show you something to prove it's pretty interesting. This, of course, assumes that a Biden win will be realized, and that seems as of right now, that is what is likely to happen. During these years when the incumbent party is set to lose, the S&P tends to realize weakness through the first quarter of the election year. Check. Bottoming in the middle of March. Check. Followed by a rally through to a peak at the start of September. Check. The period between the start of September and the end of October sees a weakening trend. Check. Followed by a rebound through the end of the year as the election event is put in the past. Check so far. So the magnitude of the moves this year certainly differ compared to that average path, but the major turning points have certainly been consistent. Let's take a look at that. What did I just say? During the years when the incumbent party is set to lose, we see bottoming in March. There's point 1, followed by a rally or peak into September, point 2, followed by weakness between September and October, right here, between 2 and 3, and then a move higher. So that's the big question mark. Will we continue higher into the end of the year? Only time will tell. So the last best 6 months, during the last favorable time frame for stocks, the S&P actually lost 5.1% between the end of October 2019 and the start of May 20, which is the 4th largest drawdown ever over this seasonally strong time frame in the past 50 years. The last time the large cap benchmark was weaker at this time of year was in 07 and 08 when the benchmark fell by 8.3%. And we all know what happened back then. Corona. So we'll quickly talk about this one more time. The dislocation of seasonal norms due to the shutdowns has obviously been hampering economic output. But when those restrictions were lifted, we saw some of the strongest gains. It's been a huge benefit to stocks this past spring and summer, even into early fall, mitigating the seasonal norms that call for a flat equity curve during the most volatile time for stocks to the 3rd quarter. Think of late summer, August, September, and even October, be very volatile months, notorious for being very volatile months. So we saw the second strongest gain over this time frame, again in the last 50 years, falling just short of the 20.21% gain recorded in 1980. What's going to be the main driver? Would say the consumer. So the year-to-date change of retail sales has climbed back to the best level to this point in the year on record. Why? Low cost of borrowing, cheap energy commodity prices, stimulus measures meant to mitigate the impact have left more in the wallets of the consumers, which have allowed them to spend. That is critical. The backdrop going into the holiday period remains very encouraging, but we would be naive to think that spending can maintain this trajectory without the help of further government stimulus. And that's continues to be negotiated, at least at the time of this presentation. Healthy labor market. The health of the consumer is often dependent on the health of the labor market, making continued claims an important metric. So while the return to normal still appears to be a distant prospect, the ongoing decline in the trend is enough to suggest improvement in the economy, which inevitably should be supportive of risk assets, i.e. the stock market. So the continued count, the initial claims, that is, initial jobless claims, the continued count typically rises through the final few months of the year. And so far, there seems to be no evidence of a shift in the prevailing trend. Let's talk about the manufacturing economy. Helping the labor market has been the above average monthly increase in manufacturing activity as manufacturers are seeking to replenish their depleted inventories. Recent manufacturing reports show that increases to this activity is trending above average going into the 4th quarter, providing merit to the contention that the manufacturing side of the economy would carry the broader economy to the back half of the year. So seasonally, stocks in the industrial sector tend to gain through the 4th quarter, lifted in part by transportation companies as the result of people and things, the movement of people and things around the year of holidays. And we'll talk about that a little bit more detail. So going back to the presidential election impact. So far, the average performance of the S&P during years when the incumbent party loses the office of the presidency has been an effective guide for the path of the broader market this year. Would you agree? Did you see the example I just showed you? That is a verbatim path. So we cover those stats, the actual chart, but what about next year? It's pretty much time to start looking forward to next year to see how the market will react during post-presidential election years under both scenarios, when the incumbent party either wins or loses. Post-presidential election years are typically nothing to get excited about, with the average return about 6.8%. And I'm talking about the S&P, and that's based on performance over the last 7 decades. So post-presidential election years are when new presidents seek to enact their agenda, and the positive influences that were floated in order to win the election have already been absorbed by the market. The market performance is rather lackluster as a result of the investors adjusting to the change in the top spot. But that lackluster performance when new presidents seek to enact their mandate really becomes prominent when the average path is separated between those years when the incumbent party wins and when the incumbent party loses. So when there are years when there's a shift of power at the top spot, the average return of the S&P for the post-election year is a mere 2.3%. Compare that to the performance of the S&P when the incumbent party retains the presidency, which is 11.8%. And a lot of that is due to the uncertainty that surrounds the shift of leadership. So it's quite obvious. Take a screenshot of this. These are potential key turning points in 2021. So I'm going to talk about both scenarios. For the years following the loss of the incumbent party, which means a Biden win, the major turning points in the market can be seen around the end of February, the middle of May, early July, start of August, and the end of September. Those are all indicated by the green circles. So overall, the average trend is pretty range bound, but should the incumbent party maintain the presidency, i.e. a Trump win, the turning points can be seen around the middle of February, the beginning of March, the start of April, beginning of August, and the end of August. So those are highlighted in red. Did everybody catch that? So we're going to be watching with great interest to see how well these turning points next year correspond to the average patterns. Let's talk about some more key data. On average, over the 2-year period, the market does better following a Republican win, 8.3%, than a Democratic win, 5.8%. But over a full year term, the average difference virtually disappears. We're left with an 8.6 versus an 8.8% for Republican presidencies and all presidents, respectively. I know that's probably a mouthful if you want to digest this chart a little bit. So the contrast is more extreme when there's a sweep. When Republicans sweep, the 2-year average for return is 12.2%. Versus when Democrats sweep, it's 3.4%. But again, after 4 years, the difference is almost gone. 8.6, this is positive, plus 8.6 versus plus 8.2 respectively. So will it all come down to fundamentals in these most unusual circumstances? That's the $64,000 question, right? Okay, here are your notes for potential fuel. This is potential fuel for stocks. What does this mean? Credit balances. Credit balances and margin counts often are indicative of short positions, and these have risen well above average this year as investors and traders remain skeptical of the market rebound. I'm one of them. I put a lot of cash, I put aside a lot of cash trading around themes and names that I felt very confident in. So investors have, for a good chunk of this year, have been betting that the market is heading bearish or is clawing its way into a significant peak. But of course, this year, the bears have been proven incorrect, making them vulnerable to further short covering through the end of the year. So short covering, another potential piece of fuel. So should significant downside follow through fail to materialize, we could see some substantial short covering into the quarter, into the end of the year. That could provide some extra fuel for stocks for the last 2 months of the year. Let's talk about November. November expectations, although we are here in the middle of November, they still hold relevance, still very important. Returns have ranged from a loss of 11.4% in November of 73 to a gain of 10.2% in 1980. Gains, once again, tend to be dominated by the first few days and the last few days of the month as investors are jockeying around position around month end. Particularly the period surrounding the U.S. Thanksgiving holiday tends to see upbeat results as the sentiment and managers are taking vacations, thereby limiting negative bets ahead of the month being December. And we see strength continuing through the last month of the year, again, finally peaking at the start of January when trading returns back to normal. Let's look at the S&P, a little bit of technical analysis here. The dominant pattern that remains on this chart is a broadening megaphone pattern. So we can see that we've got rising trend line resistance that have previously hovered just below 360 here. That's had previously capped the upside advance and led to that recent pullback. We've since cleared that. Assuming no material change in the economic fundamentals, market participants appear likely to defend levels around this 200-day moving average, around 280, 285. Below that, you've got to think that the issues with sentiment of longer-term traders and investors would be implied. This is a monthly chart. Benchmark continues to move in this long-term rising trend, which spans the last decade. This goes all the way back to 2009, 2010. March's break right here, March's break of that lower limit of the rising range did poke a significant hole in the long-term rising trend for stocks that had been placed since 2009. But the lack of follow-through or evidence of rollover below that peak suggests that while we can maintain a certain amount of caution, we can't put on our bear suits yet. What else do we see? Negative momentum divergences can still be seen with respect to the RSI. This is the RSI down here. Doesn't matter if you're looking at MACD, stochastics, anything else. It's been showing lower lows and lower highs for the past couple of years, indicating that buying pressure was waning and prices continue to climb. Usually, this type of action can be a precursor to the change of the prevailing trend, but we've never got any type of break. So for now, the longer-term trend from this look is still very much positive, and it would be pure speculation to suggest the conclusion that we're going to go down. We'll try to short this market. Let's talk about bonds. Bond prices are showing a declining trend. Bond market is showing resistance. We are entering a seasonally weak time of the year for bonds. And do we have technicals that can confirm that? Let's look at TLT. This is a daily chart of TLT, the 20-year bond index. Negative seasonal tendencies combined with negative technical setups present an ideal framework to execute either a bearish strategy in TLT or an inverse bet against bonds through TBT. Over the last 11 years, TBT has gained in 82% of the time over this period, averaging a return of 2.5%. And here is what TBT looks like. We've got this rising channel looking for a breakout, clear basing going on, and looking for a breakout and a move to the upside. So we know that bond prices have historically been another key metric of risk sentiment, and when they are in decline, it suggests that investors do not foresee anything on the horizon to be cautious of. This can have a positive impact on equity prices, particularly those in sectors that would be expected to benefit from higher rates, such as banks. But the flip side is that those sectors that typically benefit from a low rate environment, such as home builders, real estate, and utilities, can certainly suffer as a result. So let's dive into some sectors. Let's talk about energy. This is XLE, the ETF that tracks energy. Feel free to take screenshots if you wish. These are monthly averages over the last 20 years. Energy, seasonally based, this commodity sector tends to decline between now and the beginning of December, falling amidst the drop off in demand following the summer driving season. The stocks of the producers, while not necessarily negative on average during the period of seasonal weakness, they do tend to underperform the market. So until a clear trend is derived from energy, traders are best to look at the sector for short-term opportunities, whether it be long or short, rather than getting married to a longer-term position, intermediate to longer-term investment. So for the month ahead, the energy sector has averaged a gain of only 0.7%. Positive results have been realized in 60% of the time over the last 20 years. The financial sector, XLF, these are all the SPDR, the major sector ETFs. You see that consolidation has also been apparent in the financial sector here as momentum stemming from the market lows in March wanes. The sector benchmark has struggled to advance above this key resistance here around 25.27. You see this week we are breaking out to the upside. We had a large gap there on Sunday or Monday morning, and that's where we are sitting today. Seasonally, while positive tendencies for many sector constituents are already underway, and that is clearly evident, there are a couple that have not quite picked up some legs. As a whole, in November, it's a really rather muted sector compared to other areas of the market. Financial sectors only gained 0.7% in November, and the frequency has been about 65% positive over the time over the last 20 years. Let's talk about industrials. Industrials, go ahead and put this on Santa's favorite list. So while businesses have been slower to return to normal following the downturn in March and April, there is now a tailwind behind companies in this space as manufacturers feel the pressure of meeting stronger consumer demand. You can see that it's very evident in these charts. This is one of the better paces of the past decade as consumers buy things like cars, computers, in order to create that bubble that we talked about earlier, things that are close to home. There are certainly questions pertaining to the sustainability of this trend, but for now, there's certainly a bonus to help certain segments of the economy return to normal. But we are approaching resistance, so how we react here will be a clue into further gains. Seasonally, for the month of November, this sector has averaged a gain of 2.6%, and positive results have been realized 85% over the time over the last 20 years. So this is one of the best frequencies of success out of any sector for any month of the year, emphasizing the significance of the buy and demand that is normal at this time. So go ahead and make a note of that. Consumer discretionary, XLY. This one has also been a bright spot in the economy, showing activity through the end of September has been the best on record. The stimulus and the creation of these self-isolation bubbles have been a significant catalyst. Also evidenced right there in the chart that you're looking at. It's a weekly chart of XLY. Consumers have been buying autos, building garden, buying garden materials, buying new homes, home restoration products, sporting goods. Now that stimulus measures have expired, the consumer is being forced to kind of stand on their own feet again for the first time in this downturn, not really for the first time, but for quite some time, leaving the spending questionable through the prime retail period. Expect people to continue to still spend money. So along with other cyclical sectors, consumer discretionary benefits from a broad period of strength between October and May. And for November, consumer discretionary has averaged a gain of 2%. This sector has shown positive results 75% of the time. Let's look at XLP, consumer staples. This sector, as you can see, is showing double top resistance and momentum indicators, along with a lot of other things in the market, are negatively diverging from price. But consumer staples, they tend to hold their ground through periods of volatility, thereby providing an effective way to stay invested while lowering overall portfolio risk, also known as beta. For a defensive bet, given its exposure to the consumer during the spending period this holiday season, the sector tends to hold up well into the US Thanksgiving holiday. After that, it actually tends to underperform through the end of the year. Volatility in the equity market also tends to subside as the year comes to a close, mitigating the need to hold these lower beta assets. So for the month ahead, over the past 20 years, despite the defensive characteristics that the staples sector has shown, the average return has been about 1.2%, 70% of the time over 20 years. So this trade, particularly with respect to the returns relative to the broader market, will be highly dependent on whether or not the market becomes risk averse again amidst the coronavirus overhang. This sector, I will say, continues to present an appealing risk reward proposition relative to the broader market. So make a note of that. XLV, healthcare. I personally don't like jumping into healthcare, especially when we have a lot of news-driven headlines. But much like everything else, this sector had consolidated in recent months as we had all this election uncertainty, vaccine uncertainty, and debate on further economic stimulus continued. So over the last, over the past 5 election years, which is 20 years, the sector has rallied about 8% between March and July. The election year influence tends to shift that period of seasonal strength that typically runs between May and December. The months surrounding the election itself tend to be pretty volatile, and that's why we've stayed away from this sector. But seasonally, for the month of November, over the last 20 years, the healthcare sector has gained 1.9%, 80% of the time. Technology. Everybody loves technology. This is XLK. So stocks in this space have become significantly extended and overbought. Before we had a little bit of mean reversion there in the month of September ahead of the close of the quarter. This is typical of market activity through the last month of the third quarter as areas of all this excess unwind, as investment managers are rebalancing their books and their portfolios. So for this reason, the tech sector has tended to be one of the weakest segments of the market at this time. But that weakness typically leads to good buying opportunities for the broader period of strength. For November, the tech sector has gained 1.3% with showing returns 65% of the time. Again, it's over 20 years. So we know that the pandemic has created substantial demand for computers, electronic products, etc. since spring, which helps support new manufacturing orders for these products. So that had created a tailwind in itself behind some of these stocks of tech companies through the spring and summer as the traders and investors gravitated toward the growth of fundamentals embodied within the sector. All right, last sector here is utilities, XLU. Historically, utilities are the worst performing sector of the market on average. In the month of November, over 20 years, utilities has lost an average of 4 basis points, 0.4% in November, and only 50% of periods in 20 years have shown gains. So this is a market we want to be cautious being long. Why is that? Utility production tends to decline into the fall period, while the actual supply and demand metrics for companies mean little to investors who would primarily search of yield. Overall, utility production remains well below seasonal norms, but with the number of corona cases back on the rise, the strength of demand remains questionable through the winter. However, the sector does remain an attractive alternative to generate yield in portfolios, especially those for longer term investors. When you compare that to the yield on the 10-year Treasury note, just hovering around 0.8%, with the yield on the utility sector at slightly over 3%. So this will continue to make this sector a viable candidate for income seekers. What about commodities? We covered a lot. We covered sector seasonality, possible expectations, but we must also cover briefly a few commodity sectors that could be primed for moves heading into the holiday season and into 2021. Let's hit a few up. First one is the US dollar index. You can look at UUP, the ETF. November is one of the strongest months of the year for the US dollar, which has resulted in a noticeable absence in seasonal strength for commodity prices. Ag commodities predominantly trade lower following the harvest. Oil typically continues to slide following the peak demand period in the summer, and metal prices tend to underperform the broader equity market by comparison. So the US dollar index, all those things I just said are in line with a favorable US dollar, but the US dollar then enters into one of the weakest months of the year, December, which then will help boost equity and commodity prices that are traded against the greenback. So here's a daily chart. This is a weekly chart, areas that we're watching. This is a daily chart. You can see clear evidence of the basing that's been going on since around the August timeframe. We feel like the risk reward opportunities are favorable in this circumstance. So we're watching for potential longs in UUP and the US dollar index futures. Let's look at a few other additional markets that we're expecting to see some moves in from both a seasonal and technical perspective. Gold, the most popular ETF is GLD. You could trade IAU, UGL, DGZ, DGP, some of those other leveraged ETFs. Let's take a look at gold. Notice a couple of the key turning points based on 15 and 40-year historical price analysis right here in mid-December and also into January. We're looking for higher prices. Can everybody see the arrows? Can everybody see these okay? For some reason I cannot see those on my preview screen. Check, check. Okay. Why? Anyway, there's an arrow here and an arrow here. I don't know if you can see that. So going to a weekly chart of gold, yes, some would say we're a bit extended. These are areas of price structure that we would be interested in buying on pullbacks. If you drill down into some of the lower time frames, such as the daily and 4-hour, you're going to see broader based triangles and trend line support resistance forming that we're closely monitoring. Here's another commodity. Who here is trading commodities? Anybody in here trading commodities? And I need to pick up the pace just a little bit. I'm sorry. So you could track WEAT, the wheat ETF. It's also a commodity group we're watching very closely, not only wheat, but also the soy complex as well as corn. Here is a seasonality based window of wheat, 40 years of data. You can see from 15 in 40 years on the March contract. This is the March Chicago contract. The market typically tops out around the beginning of December and carries on into January, February. See this right here? See this peak? Look at the downdraft into January. This is what we're watching on a daily chart of wheat. Broad-based head shoulders top at key resistance with projected downside targets to the 50% retracement level. Sugar. Let's talk about everyone's favorite holiday, guilty pleasure. If you have young kids at the house like me, sugar will be flowing throughout your house at this time of the year. In fact, it pretty much flows 365 days of the year. If you don't trade sugar futures, you can look at SGG, the ETF that tracks sugar. 40-year historical price basis. Nove in December are not as definitive as far as price declines go, but it certainly does not indicate any strength. Patience is required as we may not get our full topping or seasonal down pattern into January or possible even into February. Here we are, trade sideways. We start to hit that down drift lower. We look at a daily chart of sugar. We're arching up into resistance and also have key divergence. So we're watching and waiting for a technical pattern or topping confirmation to take calculated risk short positions. But why seasonality? Say, Silas, there are hundreds of strategies out there. Why seasonality? It's a great question, a logical and thoughtful question that any prudent trader or investor should ask. Simply put, there are markets, stocks, indices, commodities, currencies that have very distinct and clear patterns that repeat themselves over and over and over again. So the real question that I would ask is not why seasonality, but why not? Especially when you can prove it by science, a scientifically proven strategy, one that has beat out every other traditional investment strategy. There was a study that analyzed over 200 years of data across 68 markets where they reviewed the returns on several different investment strategies. Trading off of seasonality outperformed all other strategies, so it's hard to beat 200 years of proof. Let's highlight some recent case studies. This is a recent case study on Chevron. We can see two distinct examples here. A start date, a short bearish trade on Chevron on or around 9/22, taking it down to 10/28. A bullish setup on 10/29, taking it up to 11/11, $69 to $86 on that move, good for $17 a share. And that's actually $1,700 per 100 shares, but I think you get my point. Let's look at Tyson Foods. Here's a bullish window on Tyson. Start date on or around 10/27, right here in this window. Traded to the upside, calls for continued strength through or up to December 8th, $56 to $63. Here's another example, Lanier, LEN, bearish setup on or around 10/20, which happened to be in this window right here. We had plenty of topping confirmation, divergence confirmation, took us down to next area of price structure to 82 to $72. How did I know to be looking to go long or short on or around these dates? Let's look at some commodities. Here's a trade that I recently took in natural gas. Call for a bearish setup on or around 10/14, in date of around 10/29, 83% win rate. That trade yielded 55 cents or $5,500 per contract. Here's another commodity example. Live cattle, another trade that we took. Start date on or around 10/29, end date of around 11/11, 113.5 to 107.60, 5.9 points or $2,300 per contract. But how? Does seasonality work in currencies, do you ask? The FX market, absolutely. Let's look at an example in the Kiwi yen, New Zealand dollar versus Japanese yen, all for a bullish trade on or around 9.9 as we were close to penetrating this resistance level. We're spending time out here, almost getting ready to combust to the upside. That's exactly what we did. 225 pips, depending if you trade standard or mini size, you had varying results. But how? How? Well, you now know the power of seasonality. You now have the knowledge of historical cycles, and you're ready to take action. But what's next? What's next? Because the methods I just showed you, you can put into practice right now. And what I've already shown you today is enough to get started. You have plenty of ideas. Save you a lot of time. Actionable ideas to actually put into the market beginning tomorrow. But there's only so much time in a day to crunch through all of this historical data, all this price history, cycle, seasonal trends, and more. So I ask again, what's next? How do we even begin scouring through years, decades of stocks, futures, currencies, data, patterns, cycles? What if there was a push button solution? Literally a scan and go function that could lay out years of historical data out for you on a silver platter. Type a 1 in the chat box if you'd like to see what I'm talking about. Take a swig of water here. Type a 1 in the chat box if you'd like to see that opportunity. Plus, this will tell me if you're sleeping or awake. All right, absolutely. Of course you are. So when I say a faster way, I'm talking about a push button solution that delivers the following: a symbol, a bias, suggested intraday, suggested exit date, and even much more data. And I'm going to show you example here in just a few moments. Everything you just saw me demonstrate on those very real trade examples that we've executed in real trading accounts. What do we do? How do we do this? How do we come up with this push button solution? It's very simple. We put and developed a scanner. It's called the Smart Market Scanner to allow technology to do the heavy lifting for us. So rather than manually looking through decades and decades of data, trying to spot these patterns, we now have a tool that searches historical trends and patterns for us and locates setups that meet a certain criteria of success. So whether you trade stocks, futures, Forex, ETFs, options, commodities, there is now a push button solution. And it's called the Smart Market Scanner. We're able to locate every single one of those trade opportunities, ideas, signals, alerts, whatever you want to call them, all by using a simple piece of software, so simple that a first grader could use it. This is the Smart Stock Scanner. We also have one for Smart Futures, and it also works just as well on stocks and commodities as it does on currencies, which can be found in Smart Seasonals Forex. So how do you access this? Great question. I'm pleased to introduce to you Smart Market Scanner Pro. The Smart Market Seasonal Scanner is your time-saving solution to finding hundreds of high probability setups in just a few minutes each day. And I've been able to put together a very special offer, so you have everything you need to take action on what I just showed you. But it's very important to me to make sure you fully understand what all you're getting here. So let me demonstrate with what you'd be receiving in this package. First is the Smart Stock software. You're going to get access to over 1,000 symbols, over 1,000 symbols across stocks, ETF sectors, 9 of the major sectors: basic materials, consumer goods, communication, financials, healthcare, industrial services, technology, utilities, everything that we just talked about. Next, you're also going to be given access to the Smart Futures platform, covering 318 markets, all 8 major commodity groups: indices, rates, currencies, grains, meats, energies, metals, softs. And then finally, the Smart Market Forex package, 37 pairs, all majors and minors: the Aussie, CAD, Euro, Yen, Swissy, Pound, Kiwi, US dollar, and the South African Rand. You can use it to trade standard, mini, and or micro lots. How do we find and locate these opportunities? How do we do it? Let's walk through this process together. Let's walk through this process together, and let me show you. So this tool allows us to search or filter by a particular or specific month or a specific symbol. We can also dictate the type of trends that we want to see. How profitable do we want that trade to be? Do we want it to be only see trades that have a 70% win rate, 75, 80, maybe even 100? Yes, we can get results that show 100% profitable trades. We hit the scan button, and what would take possibly years to deliver is delivered down in seconds. And you're not only limited to just the symbol, entry date, exit date, as I mentioned earlier. There's enough data to create an entire computer model. But as I said, I like to keep things simple. And we can also go back and see how that trade has played out historically. If you want to look at past seasonal trades, we can utilize another neat feature of the scanner, which is the charting component. So you can go back and visually see the begin and end dates for your selected market and what is or has done or is currently doing in the current market environment. One often overlooked but probably the most important aspect of trading is your risk management, your risk tolerance. You have the ability to fine-tune and tailor your own personal risk tolerance levels to see more conservative trades, moderate, aggressive trades, depending on your personal risk levels. Not Joe's, not Bob's, not Susie's, not Harry's. You use this tool to customize for your situation. You have the ability to use the portfolio balance feature and the trade size feature, whether you're sim trading or trading in real accounts, if so desired. We'll take a look at that in just a moment. You could also choose what you only want to see. You can sort by priority, which columns take precedence over the other. Again, we'll take a look at that momentarily. And one of the neatest features to me is that you can also create your very own custom alert portfolio, which can be sent to you via email or SMS text, scheduled days in advance. Truly plug and play. So let's recap what we've covered. You're introduced to the powerful practice of using historical data to guide your trading behaviors. You also learn how to understand what data you must focus on and what you can't ignore. You also saw several different ways you can shorten the amount of time you spend analyzing charts, all by finding hundreds of high probability setups that you can take action on. And now you can literally have access to the same set of tools that I use on a daily basis with the Smart Market Scanner Pro. So again, this package includes the full Smart Seasonal Software bundle. It's actually 3 separate scanners in the bundle, one for stocks, one for futures, one for Forex. Same software you just saw me demonstrate. It's going to help you identify seasonal trends that can be identified at a glance with a click of a button. Offers very detailed statistics showing you your optimal entry, optimal exit, duration, only the most important information you need. And it offers very detailed statistics showing you your calculated projected profit, projected drawdown, as well as your average daily profit, average gain, average drawdown, and much, much more. But let me ask you a question. If all this did was help you improve your record to generate more wins and losses, what would that be worth to you? If all it did was allow you to unsubscribe to other tools and newsletters that you aren't even using, what would that be worth to you? And if all it did was help you place 1 to 2 winning trades, what would that be worth to you? Look, these are some unsolicited testimonials that have come into me. I don't ask for them, but people are clearly taking action and using the scanner the way it's meant to be delivered. People are putting in some effort, maybe over the weekend, maybe Monday morning, maybe 15 minutes in the evening before the market opens, scanning for opportunities. These are individuals that are taking action. So if you want access to the same tools, resources, ideas that these and several hundred other members enjoy, I suggest you take advantage of a very special offer I have in store, the brand new release of the Smart Market Scanner Pro. You're going to get Smart Market Scanner Pro for 12 months, all 3 platforms for 1 year. You get full, complete software trilogy stocks, futures, and Forex for an extremely low price of $397 a year. The offer link is seasonalswingtrader.com/trend. I'm going to put that into the chat box for you. seasonalswingtrader.com/trend. What all do you get? You're going to get additional training. We have a 40 or 50 page plus PDF manual. We also have 13 bite-sized training videos. I think there's 12 or 13, yeah. All broken down into 2 to 4 minute segments, showing you every little piece, every little inner working of the scanner. And I'm going to show you the scanner in just a moment. This is a glimpse inside the members area. You can see your smart stock download, your smart Forex download, and your smart futures download. All of your training videos are listed down below. They open up into little modules that you can watch on your computer. And here's the PDF manual guide. The offer link is seasonalswingtrader.com/trend. And finally, just a small sample of all of the data that the software includes. So the complete offer is seasonalswingtrader.com/trend. You get access to the entire software bundle for 1 year. It's $397 a year. Folks, you can make that up in one single trade, trust me. And I will show you some trades that I am in as we speak that I've taken and pulled directly from the scanner. And I'm going to show you what I'm watching. Let me get to your questions, guys. Here is the offer again. Everything you get, 1,000 plus tradable symbols across stocks, ETFs, indices, futures, commodities, Forex. Also has a built-in neural network scanner to give you to filter out your probability on trades. Custom portfolio settings based on your personal trade size or a percent of your account. Again, whether it's sim or live. Built-in alerts. You have your own custom alert service. You can set up any of these ideas that I just showed you and come to you via SMS, text, or email. And yes, trades that have up to 100% historical accuracy. All right, so let's look at the bonus hot list that I told you, or I promised you at the beginning. And again, just the process, my process is really boiled down to 5 points. I want to see what month or what symbol I'm interested in trading. I'm looking at the win percent and the risk percent. Do I want to be bullish or bearish? I want to look at the time frame, and I scan for results. Okay, here it is again. I'm gonna put this up. I'm gonna get to your questions. So let me move that over for you. All right, guys, 1 second here. Sorry about that. All right, what I want to do is display the. Let me know if you guys can see. If you guys can see. You guys see the software? You guys can't see the software? Okay, so we have. All right. Okay, cool. All right, so we have smart Forex, we have smart futures, and we have smart stocks. Okay, so this is the application. This is the application. Just what I showed you in the slides, but in a real environment. So here are all of the tabs. There's 1, 2, 3, 4, 5. You're only going to probably use 3, maybe, or maybe 4 actually. And these windows here are all pockets that you can put your own variables, your own data, your own variables, your preferences of what you want to scan against. So if we want to look for month or symbol, say the month, we can sort by month. If we want to look for symbol, we can sort by symbol. Here is, do we want to find trades that have showed, 70% profitability, 80%, 90%, 100%? Obviously, the lower that number is, the more results you're going to get. And then trends that lasted a minimum of a number of days and up to a maximum number of days. So depending on your style of trading, and maybe you are normally a swing trader or a position trader, but maybe you want to dial it in tighter from, say, I don't know, 7 to 14 days because of the market environment. Or maybe you're a short-term trader and you only trade weekly options and you're scanning for trends that have lasted 2 days but no more than 7. And then here's where you dictate how many years of data you actually want the program to go back and search against. Based on this data and this data alone, yielded 865 results. So once we find a particular market, notice that as I'm clicking on these, the bottom window pane is changing. This is your equity curve based on if you had bought and sold this stock on the dates it suggested every year for the last 11 years, trading 100 shares of stock. You can change this value, or you can change this either to quantity of shares or a percent of risk on the account. And we have an upward sloping equity curve. This is a year by year table. Think of it like a candlestick. The high of the wick being max gain, low of the wick being max drawdown during the life of the trade. Here's your risk reward graph, and then here's a year by year table, just showing you begin date, begin price, end date, end price for each of those. Once we find some markets that we like, we can select these and then add to step 2. That takes us to our portfolio tab, which these were already in here. I'm happy to clear those out. So let's move those. Let's say that we just like these 3, we hit add to step 2, takes us to our portfolio. You can see how very quick and intuitive it is. So here we have these 3. This is where we would run our neural network scanner based on our individual risk tolerances. All of this is described in much more detail on how these work. It's also explained in the guide. Do we want to trade a certain quantity, or do we want it based on a particular percentage of a dollar value of our account? Okay. Once we find these and we run our neural network scanner based on whether we run it or not, let's say that we like all 3 of these, we can add those to our trade alerts. And we already had these in here, so I'm going to go back and add these again. So we like these, we added trade alerts, and that adds her to a trade alerts. Now we can set these up to come to us 1, 2, 3, 5 days before its suggested start date. So it's completely set and forget, plug and play. And we can have these come to us via email or SMS text. Okay, pretty much as simple as that. Your settings tab is where you're going to select which sector or what group of markets you want to scan. You want to scan the S&P, NASDAQ, Dow, ETFs only, or all these various sectors that I just covered right in here. Okay, and you can also create your own custom portfolio. Going back to this main tab, all of these columns are sortable. You can see all of this data we talked about all the way down to the industry and sector, whether or not that stock is optionable or not, total historical profit in percent and in dollars, max drawdown, average drawdown, max gain, biggest profit, risk reward, average profit, all of this key data, all this key data. How many years of historical data can you scan? You can scan over 20 years. Over 20 years. I don't know what the precise number is, to be honest. I'll look into that, but you can scan over 20 years. And then obviously some stocks or some markets won't go up that far because they haven't been around long enough. So same thing, same process in futures, except Obviously, you're not going to have sectors, but you're going to have commodity groups that you can scan from, or you can select all. And again, you can select your own custom there. And then Smart Forex is also going to be the same situation. Same situation, same process, adding to your portfolio, to your trade alerts, and then your settings. Here's where you can just remove or add the different markets that you wish to follow. Okay. Let me look at some other questions here. Oops. Let's see. I think I lost you for a second. Do I only go long? No, absolutely not. Especially in the commodities and currencies, I play long and short quite frequently because they're not all of those are going to be correlated to the equity market. As far as equities go, no. I think over time, especially if you're long-term minded, the bias is to the long side because the market has always historically gone higher. But I will certainly play the long and short side, primarily use it trading options. Does volatility affect seasonality? Yes, of course it can. As we saw with the March meltdown, any other type of extreme, kind of black swan events, maybe the financial crisis, things like that will certainly skew the seasonality statistics. But keep in mind, the stats you see are going to tell you the number of years of data it contains. So although we may have anomalies in the market, the key is over time, as it showed historical success rates. And if it meets your criteria of success, then you can go into that market with confidence and execute the trade. Now, do I just use that blindly? No, not at all. I'll combine it with, I drill down into the charts. I look at the bigger time frames. I drill down into the lower time frames, and I'll try to pinpoint my entry and let the market come to me. I don't chase the market. I'll enter at points of value or points of breakouts or momentum. Does it give you strike prices? No. This does not give you any type of options data. So if you want to trade options around these ideas, which I do primarily, you have to determine how you're going to play that. Everybody's different, lots of different option strategies, option variables. Whether you trade straight calls and puts, call debit spreads, so on, or if you trade credit spreads. And then of course all the other nuances with options, what strikes, what expiration, what kind of premium, what are you willing to risk. Does the platform need to be running to get alerts? No, it does not. There's no data fee, does not require a data fee. There's no extra fee for data. Yes, I do use it for option. No, this is not a one-time fee. It's a one-time fee for a year. This is a good for a year. It's $397. Should offer, yeah, the offer is seasonalswingtrade.com/trend. Seasonalswingtrade.com/trend. Back up for you. All right, there's the offer, seasonalswingtrade.com/trend. Get back to your questions. We can help to get you set up, although you probably won't need it. It's basically a 1 or 2 click download once you get inside the members area. I see a lot of people joining. I appreciate that. If you got you should get a welcome email within just a few moments with your login credentials. The available sectors and stocks are right here. Basic materials, communication, consumer goods, financial, healthcare, industrial services, technology, utilities. 1 year. The alerts come from the platform. In the platform, the scanner software does not need to be open or running, nor does your computer. You can shut it down, lock up your computer, go on vacation, And if you set up the alerts to come to you via email or SMS text, you'll get those sent to you accordingly. This comes with one license, one computer. I can't help answer commodity related inquiries. So if you ever have questions about a particular scan, a particular market, you can email me. If you don't understand some of the nuances of regarding commodities and things like that, certainly. Yeah, so let's talk about the hot list. Let's talk about the hot list here. And I'm gonna go back to, so let's go to the charts here. So what I do is I like to take my scans, the scans that I find, and I will, you can copy and paste those into an Excel file or a Google Doc and upload a watch list. So each month what I do is I create 3 watch lists, bears, bulls, and a hot list. And I go through these right there at the end of the month or the beginning of the month and see how we're all shaping up. I'll flag the ones that I like and the ones that then get moved over or transferred to my hot list. So let's go to the hot list. So these were all my bears. These were all my bulls. These are all what I transferred over from the scanner based on a score from 3 to 5, and that's detailed in the members area. It does not mean that I take all 865 trade ideas and look at them. I cull them down even further. And then I create a hot list. So if we go to my hot list, a couple ones, actually, let me show you that. Let me show you some trades that I'm actually in right now, and we'll see if they can still be considered. Most of them are on the move. So I am long T. I'm long AT&T, T-Mobile, based off the scanner. I'm also long Xerox based off the scanner from right here at 2050. I'm also long Mo, Altria. Mo has been a nice trade for me, moving from 38.40 up to 41.40. WFC is one that can just got in today. Just got in today. Actually sent out a free video out on that one. Some others that I'm looking at. These are not trade recommendations. These are just trades I'm looking at. Allstate. These are all based off the scanner. Delta Airlines. Watching Intel closely. Watching Juniper closely. Kohl's had a nice breakout today post earnings. A couple of the bearish markets that I'm watching closely are ABC, Amerisource for a potential bearish scan. Never got my head and shoulders top that I was looking for, but now we're even more extended. Also watching CSX for potential short, no confirmation yet. First Solar. Got the SLR. Did I put that in right? There we go. Watching First Solar for potential short. Watching TRV. Trading into structure here. And I'm watching UPS. United Parcel Service got a nice head and shoulders top forming right here. I see 12 of you guys have already taken advantage of that. Congratulations. I mean, at $397 a year, I don't know, what does that break down to? Something ridiculous. $33 a month. Watching at one point. I'll certainly be eyeballing this one here at the 786 around here. So I'll see how we react at these levels. Yeah, you can certainly use these for weekly options. How profitable are the alerts? Well, all you gotta do is look at the scanner and it'll tell you how profitable it's been. 82%, 86, 88, 88, yada, 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 88. Stock auction year, 88, 89, 100. All right, guys, any more questions? Should have no problems downloading. It's not complicated. I don't even think we haven't even done a tutorial on how to download. It's click, click, boom. Yeah, absolutely. This has been fun. Hope you learned a lot. Send me some feedback if you don't mind. Send me some feedback. This is the first time I've ever done this presentation. Support at seasonalswingtrader.com. Tell me what you like, what you didn't like. Was all that data useful? Hopefully it was useful, it was actionable, gave you lots of ideas, showed you how to possibly position yourself. Yes, we focus on the long side. Why? Because that's what has happened the majority of the time over years and years and years of data, decades of data. That's what we want to trade alongside with. So hope all that was helpful. I appreciate everybody that has hopped on board. Email me at support@seasonalswingtrader.com if you have any additional questions. Good luck get trading out there, guys. Stay safe, and I look forward to seeing you on the next update. Take care.